Athens was nearly ripped apart into a civil war before Greece entered its classical phase. This was due to extreme wealth inequalities that had been building from years of land concentration and debt bondage. Now, this is a problem that we even see today. In fact, if you look at one of the 5 reasons for the Great Depression in John Kenneth Galbraith's book, The Great Crash, he indicated that the continued development of wealth inequalities played a major role in the stock market crashes from October 1929 onward. I say crashes plural because it wasn't just one crash. The economy was dependent on a high level of investment or high level of luxury consumption, or even both. This sounds a lot like what we are seeing in 2025, 2026 in the United States, by the way. Athens was at a crossroads. As such, Athens brought in Solon, the legendary statesman, lawmaker, and poet, to the highest rank in the Greek government to make the necessary changes to steer Athens back in the right direction. Therefore, sometime around 600 BCE, Solon laid the foundation for Athenian democracy through a series of economic and political reforms. His most significant acts included canceling debts and abolishing debt slavery, reforming the legal code to replace Draco's harsh laws. Furthermore, he reclassified citizens into 4 groups based on wealth rather than birth, which expanded political participation and laid the key groundwork for the rise of the Athenian democracy. Although he was of elite stock, he championed reforms that helped the lower classes. Additionally, Solon was not hostile to commerce or enterprise. He standardized weights and measures, encouraged olive growth cultivation for export, and supported broader economic developments. Interest rates in ancient Athens remained unchanged for centuries, with the Temple of Apollo on Delos charging a stable 10% from the 5th century to the 2nd century BCE. Unlike modern interest rates that fluctuate with market conditions, ancient Greek rates were defined by custom and sometimes by law, with 10% serving as the typical standard. Solon did not abolish interest rates, but reformed its practice within a stable economic framework. Solon further stimulated trade by introducing new Athenian coinage and encouraged professional occupations. While political rights continued to depend on birth because citizenship still required Athenian parents, Solon did extend citizenship to certain skilled foreign craftsmen and merchants in order to strengthen the city's commercial prospects. By abolishing debt slavery and promoting trade, he offered new economic opportunities and lifted many impoverished citizens out of hardship. Archaeological evidence suggests these policies helped fuel a broad commercial expansion, accelerating Athens' participation in Mediterranean trade. Most importantly, Solon's reforms did not only resolve Athens' debt crisis nearly 2,600 years ago, but also established the institutional foundations that later enabled the development of direct democracy and a navy that would prove to be a dominant sea power, and thus a dramatic increase in economic activity through long-distance trade. Therefore, the classical Greek civilizations that developed surpassed its ancient counterparts in the Near East through sophisticated financial economics based on money, through their adoption of coinage, and their local and foreign markets. In large part, Athens had no choice but to adapt to the sea, as Athens had outgrown their local agricultural capacity and therefore had no choice but to import overseas cereals or face famine. In general, the city-states south of Macedonia had poor soil and not enough rain. In addition, Greece didn't have massive rivers like the Nile, the Euphrates, or the Tigris that could provide the water and the alluvial soil necessary for agriculture. Their lands couldn't feed the local populations that continued to grow since the late Bronze Age collapse of around 1200 BCE. Therefore, Athens imported much of its wheat from faraway places like the Black Sea. Athens needed to induce farmers overseas to grow excess grains for export. Therefore, the Athenians would have needed to trade with them something that they wanted as well. When importing wheat, Athens primarily traded fine Athenian pottery, wine, olive oil, and luxury goods in exchange for grains from the Black Sea region. More importantly, Athens also had excess silver coins that were mined through slave labor in the Laurion mines. Olive oil was a major export, but olive trees didn't bear fruits every year, so silver was crucial in that trade. Athens, as well as other ancient societies, had another major hurdle in the import-export business. They also needed to inspire sailors and captains to risk their lives to bring back the grain. There also needed to be a system in place that would allow for direct investment in ships and trade goods, and have a system of payment that was healthy enough to handle the unpredictability of international commerce. Athens had to deal with the volatility of the sea and monetary systems that relied on universally accepted measures of value. Also, Athens needed to have legal frameworks in place that could adjudicate conflicts and enforce contracts. Consequently, much of what we know about ancient Athenian trade and its fiscal systems comes from surviving judicial documents and courtroom speeches. The courts themselves were essential to the city's financial infrastructure. The Athenian legal system settled disputes through jury trials, with panels typically consisting of about 500 jurors selected at random. Much different than modern American juries where we have up to 12 people. So it was 500 people you were speaking in front of, so this is a vast pool of people. These jurors served for a single day, so it wasn't a month long, a week long, or whatever. It was just one single day, which was the self-imposed maximum length of any trial. So no matter how complex a trial could be, it was just one day. So you had to be precise, and you had to communicate what you needed to these jurors, and they had to understand what you were telling them as well. Plaintiffs and defendants represented themselves. However, it wasn't uncommon for prominent orators to be hired to compose their arguments. Speaking time was strictly regulated by a water clock, so the arguments needed to be strict and to the point. Jurors were not sequestered, so they could not deliberate collectively. Instead, they cast their votes individually, and a simple majority determined the verdict. By the end of the day, the case was resolved. Athenian jurors were paid a daily fee, originally set at 1 obol, later increased to 3 obols, or half a drachma, around 425 BCE, possibly under Cleon. The pay was introduced to allow poor citizens who could not afford to lose a day's wages to serve as jurors. This ensured that the jury service was not limited to the affluent and was designed to be a form of public investment in popular sovereignty. This system was widely used for commercial disputes, many of which involved the Athenian grain trade. Special courts for maritime cases convened from September to April, when ships were out of service, and business disputes could be settled in time for the next sailing season. Most of the people in and around Athens had to know that they were at the mercy of foreign merchants to bring enough food at a fair price into the city and the surrounding region. Athens' first step was to address these concerns through their legal code. For example, 2/3 of all imported grains were allocated to the city of Athens and prohibited storing more than 1/3 for later sale. They took this very serious, as shipping grain to any other port by an Athenian citizen was a serious crime, one punishable by death. In addition, their markups on resale were capped. Consequently, even though Solon had implemented many rules and regulations well over 100 years prior to address these overly harsh laws established by Draco, and where we get the term draconian, well, these penalties were never fully abandoned. The law also ensured that maritime loans could only be extended to ships carrying grain to Athens. Once grain was brought into Athens, laws constrained the profits allowed on grain dealing. Dealers could only store a limited amount of grain. All these regulations were enforced by official market overseers. From there, these allegations would be brought up in court, and they could have been judged by a jury of their peers. If the case was severe enough, the consequences of being found guilty could be grave and therefore very harsh when compared to modern standards. For example, a case in 386 BCE involved a group of Athenian grain dealers who faced a potential death penalty due to their alleged actions. This all stems from the fact that Athens was heavily dependent upon imported grain, and food security was a critical political and social issue. Therefore, the grain trade was highly regulated to ensure a stable and, more importantly, a fair price. During a period of high grain prices, which could have been out of the Athenians' hands because it could have resulted from supply shocks related to a war outside of Athens or some natural disaster. The Athenian grain regulators encouraged grain importers to form a buyer's cartel to get economies of scale to lower the prices that they paid to shippers. Grain therefore followed cycles. It was sometimes expensive and difficult to obtain. Prices to importers rose and fell with supply and demand. Grain prices could suddenly double if the invisible hand was allowed to work its magic. However, the plan to get prices lowered through economies of scale apparently backfired due to the supply and demand curve. The reason being is simple. Lower prices meant that the suppliers were naturally going to get lower amount of money for their grain. So what they did is they diverted their grain from Athens to other regions. This in turn caused the supply to shrink in Athens, thus the price would have naturally increased. Because ultimately, if you lower the supply but keep the same demand, prices naturally climb. Consequently, the grain merchants found themselves on trial for their lives for profiteering and hoarding through price-fixing schemes which involved them selling grain for more than they were allowed to mark up. The trigger for this grain merchant's trial appears to have been caused by a sudden price shock. It has been further speculated that it may have been due to a naval blockade of one of Athens' key grain suppliers. The dealer's defense was that they concluded at the behest of the Athenian grain market regulator, a man named Anytus, to acquire grain from shippers at lower prices. However, rather than passing the savings on to the consumers, they stored the grain and slowly released the supply to keep prices higher, which clearly violated laws against hoarding. In the end, they colluded against both the suppliers and the customers. They narrowly avoided street justice by the Athenian council, with one prosecutor arguing they deserved a fitting trial. The prosecutor in the trial recognized that the cartel would have had a long-term detrimental effect on the business of importing grain into the city. His argument was that the crucial flow of grain would shift elsewhere in response to the invisible hand of the market if the dealers knew that they could get a better price elsewhere. Additionally, investors in the grain trade would no longer free up capital to make loans on the grain voyage if prices at the docks were too low. Also, captains and crew would have little incentive to brave the risks of the sea if they could not sell their cargo at a decent profit. Lastly, it appears that the case was basically a whistleblower complaint in which a class of informers called the sycophants were probably opportunists who first looked for a bribe of some sort, because if the bribe wasn't paid, these informers would then snitch to the local official, stating that these grain dealers were circumventing the rules. If the case was then successfully prosecuted, they were rewarded with a large fee. In this particular case, the only surviving account comes from a speech written by an orator named Lysis. It was titled "Against the Grain Dealers." The ultimate fate of the accused merchants is not clearly known from the text that survived, but the significance of the case is what is considered one of the earliest recorded antitrust or competition policy cases in history. However, prosecuting these cases, which was done with the intention of lowering prices for the common people, had a potential unintended consequence, in that merchants would no longer ship grain to Athens if they could not obtain a fair price. It appears that Lysis may have known this, as he was fully aware that Athens survived only by creating a market incentive for the farmers and the grain dealers who were willing to risk their lives to brave the sea. The state couldn't overly inject to get prices lower, as laws governing supply and demand would take hold, as export and local price controls could only go so far. Only the market could tempt entrepreneurs into the grain trade by dangling before them economic profits. Much of the reason why Athens was able to get so much grain from the Black Sea region was because the Black Sea had been Hellenized by the 4th century BCE. And many places, such as the Crimean Peninsula, had permanent Greek colonies. As such, half of Athens' annual grain imports came from the Black Sea kingdoms, roughly 13,000 tons of wheat. Oxford historian Afonso Morano calculates that this was enough to feed more than 50,000 people. In fact, by his calculations, at least 1/3 of the population of Athens relied on imported grain. When you factor in the fact that so much grain was flowing in through various businesses that relied on financing from various other people or businesses, it wouldn't be surprising to learn that other lawsuits flowed through the courts involving the financing of expeditions from the Black Sea area. Therefore, Lysis wasn't the only orator that we have preserved speeches from. We also have preserved famous speeches from Athens' great 4th century orator, Demosthenes, of which he lays out a contract for a voyage. The contract that he specifically referenced was written sometime around 352 BCE. He goes on to give great details surrounding this loan that was designed to finance a merchant voyage from Athens to the Black Sea and back again. However, there was a default on a loan and a lawsuit ensued. Additionally, the speech is most likely biased, as Demosthenes wrote the speech for the plaintiff, who was suing Lacturus, the elder brother of the two young traders, Artemon and Apollodorus, who borrowed 3,000 drachmas, who was their representative in Athens. The plaintiff was an unknown person who was a merchant and a ship owner from the Bosphorus Kingdom, which is in modern-day Crimea or the Ukraine, to give you an idea where it's located. It appears that the loan was a bottomry loan, which is a high-risk, high-interest loan used to finance a trading voyage. Just like modern loans, ancient loans often required collateral in case of default. Therefore, the loan was secured by the ship's cargo, the bottom or the hull of the ship. If the ship was lost, the lender lost his money. If it arrived safely, the borrower repaid the loan with an interest rate somewhere between 22 to 30%. Most of the loans I've heard seem to range closer to 30%. The loan agreement stipulated that the money was to be used to buy wine from Athens, then sell to the Bosphorus, trade there, and then return with new cargo, which was most likely some sort of grain. However, it appears that the borrowers violated the terms of the contract as they bought a mix of goods, including jars and sponges. From there, they tried to sail to Crete and other places, and ultimately the ship was damaged as they deviated from the original plan. The borrowers died, and the lender was left unpaid. The plaintiff's only recourse was that he sued Lactrus, who held the brothers' estate and was their guarantor and agent in Athens. The speaker insisted that the jury must judge based on the written agreement, of which he read the contract aloud multiple times. This pointed to the fact that contract law was central to doing business in Athens, because the Athenians relied heavily on written contracts due to the international nature of their trade, especially considering the fact that they could not survive without the importation of grain from abroad, especially from places like the Crimea. He obviously knew and therefore anticipated Lactrus's arguments that his brothers are dead, so he's not liable. The speaker argued Lactrus, as heir and agent, was responsible for the estate's debts. The defendant would claim that it was an act of God, since rough seas were responsible for the cargo being lost at sea. The speaker for the plaintiff responded by saying that since the borrowers detoured from the agreed-upon trade routes and the cargo that was being traded, they were therefore in breach of the original contract by the time the incident at sea occurred. In addition, it is possible that they never purchased any goods to begin with, but instead lent out the cash to another party in hopes of capturing the spread between the borrowed and lent money. But either way, they forfeited the protection of the Act of God clause. The risk was then squarely placed on them. By all accounts, the plaintiff speaker projected an honest and plain-dealing tone in contrast to the apparent wily and dishonest tone of Lactrus. Furthermore, he paints Lactrus as unethical by using his philosophical education to cheat an honest man. Lastly, he contended that a verdict in his favor was crucial for Athenian commerce as a whole. If contracts like these are not enforced, no one will lend money for trade, and the city's essential grain supply and economic prosperity will suffer. The reason why this point is so important is because the transparent Athenian rules for dispute resolution attracted external as well as internal capital. If the trust in the rule of law is broken, so too could Athenian trade and economic output. That is as true as then as it is now. If you have a government that can't be trusted, who is going to do business with that country that they were doing business with prior or potentially in the future? Consequently, the Athenian legal framework can be thought of as part of the overall financial machinery. The ability of lenders to sue for compensation over events that occurred on foreign lands, along with the power of a fair defense to defend themselves against agreed-upon regulations for evidence, made the financing of long-distance trade plausible. Greek merchant voyages to the Black Sea surely involved a great amount of risk. We know this because the bottom of the seas worldwide are littered with shipwrecks of comparable expeditions. But the legal infrastructure of maritime loans and legal enforcement reduced the uncertainty about simple fraud. Athenian ports had many appealing features, such as a natural and protected interior harbor surrounded by wharves and agoras, but its vital architecture was its legal code, a tradition of contracting and commercial law. In the end, The speech was important for a few reasons. For one, it gives the modern person an understanding of the mechanics of these ancient Greek merchant loans. Additionally, it was a consummate piece of legal rhetoric that was designed to appeal to an Athenian jury of ordinary citizens who may have had their suspicions of these sophisticated traders and bankers. It's not unlike modern people's suspicions of people creating financial engineering and speculators in markets in real estate. So a jury back then, just as a jury today, might be suspicious of some multimillionaire or billionaire that is on trial for certain actions or potential fraud. A key feature in this loan, which was a common feature in ancient finance, was the borrower did not have to repay the loan if the ship sank. The lenders ultimately took on the risk of a shipwreck. This can obviously be problematic, as this could entice shady businessmen to fraudulently say the ship went down, sell the goods offshore, and then come back and say, hey, I don't know how I managed to survive. This type of lending is referred to as bottomry loans, in which the ship and cargo are pledged to the lender, but repayment was only due if the ship survived. Lenders could form syndicates, much as they do in modern investment banking, as it was a common practice for a single ship or voyage to be financed by several different lenders, each providing a portion of the total capital required. This meant no single lender would suffer a total loss if one specific ship was lost at sea, and therefore they could diversify the risks of a disaster by lending a little bit on a great number of voyages and bring in partners to share on the risk. By all accounts, it appears that the grain trade from the Black Sea must have been considerable and profitable to the lenders and the syndicates, even if an occasional ship was lost at sea, or if the cargo was lost or impaired, as the lenders were diversified enough that they wouldn't be ruined. Merchants, by contrast, rarely enjoyed the protection of diversification of risks through syndicates. When they went to the sea, they quite literally placed all their eggs in one basket. They had every incentive to buy grain cheaply in the Pontus, for example, and sell it at a high price in the Praeus, and earn enough to repay their loans. But they remained vulnerable to forces beyond their control, most notably the weather. Unlike lenders, they could not easily diversify across multiple voyages unless they partnered with traders. With the surge of long-distance trade financed by bankers and investors, Greek financiers ultimately took a page out of the Sumerian playbook some 2,000 years prior. However, the Greeks developed their own playbook, distinct from the people of Uruk and Ur. What you saw in ancient Mesopotamia was happening in Greece, but on a much larger scale. The idea of abstract wealth gained significant traction 2,000 plus years prior throughout Mesopotamia, when the temples were giving out clay tablet receipts for items stored at the temple, or people purchased debt from a third party that they could turn around and sell to someone else. In other words, people in places like Babylonia or Sumer could acquire vast amounts of wealth without direct land ownership. One could look at the landowner and see their wealth on full display. But when someone owned large quantities of receivables, that person's wealth wasn't observable by outsiders. Abstract wealth was achieved by the accumulation of bank deposits or by financial accounts or contracts. However, in Greece, the financiers decoupled their wealth from other enterprises, meaning that they could ultimately invest that money into other ventures, including maritime trade. Now, mind you, financiers in Babylonia and even in the early Persian Empire were doing something similar. They were diversifying their wealth into multiple different areas. So this wasn't necessarily a new thing. A significant portion of the ancient Greek deals were financed by their growing class of bankers, who were mostly comprised of non-Greek citizens such as the metics and slaves. In city-states like Athens, some wealthy Athenian citizens were involved in large-scale lending, along with many day-to-day banking operations, including money changing, which was vital for trade because each city-state had its own unique local currency. So any imported or exported goods would need bankers to perform foreign exchange deals. These bankers also accepted deposits and made personal and commercial loans. The ancient and even modern term for bank in Greek is trapeza, which refers to a table on which the banker conducted business. So, in other words, early bankers did not sit in some office space, but could control their operations anywhere in the local area. They just needed a place to sit and conduct business. This is possibly a big reason why banking was often viewed as a low-status commercial activity, which citizens tended to avoid in favor of agriculture or other socially prestigious pursuits. The Athenians did not have an income tax because it wasn't culturally accepted to tax income. But that begs the question, how did the Greeks finance their defense and infrastructure projects? For one, they were able to extract a lot of silver and other metals from its local mines through the use of excessive amounts of slave labor. The silver extracted was used to pay for the warships and other projects. Other aspects of ancient Greek life was the wealthiest of its citizens were expected to contribute much of their wealth to finance public goods like warships, local gymnasiums, and the production of plays for dramatic festivals, and even finance embassies for pan-Hellenic games. The wealthy were able to display their civic integrity and philanthropy to the community, while also serving as an instrument for redistributing wealth within the democracy. However, the real reason was probably more to do how this earned them immense social status, honor, and respect. With that being said, when the Athenian elites needed to underwrite ceremonial events or partially fund the navy, these could be extremely expensive, and therefore, it wasn't uncommon for them to turn to the bankers to finance these operations. While bankers were crucial for wealth protection and soundness of the overall Greek economies, they also acted as vital engines for investments. They often put their own skin in the game as they invested personally, as seen in lending bankers like Passion, who not only invested their own capital in ventures such as a shield factory, but also deployed bank funds for loans. Beyond this, they likely served as intermediaries, using their network of overseas client investments to match borrowers with lenders, a role suggested by the evidence of complex maritime agreements. Many of these bankers had their hands on many different businesses. One of the more famous of these was a man named Demosthenes, who may have come from wealth because he was wrapped up in a lawsuit in which he sued his uncles who may have tried to swindle his inheritance after they became guardians after his father died. This lawsuit wasn't a straightforward case of him receiving a lump sum of money. Instead, it was a complex case that involved multiple businesses, including a sword-making factory and a furniture manufacturing facility, along with various inventories of assets and loan receivables, such as maritime loans, in addition to money saved, which included drachmas saved by Passion. These lawsuits were a rich source of information that showed how bankers operated and how certain assets were valued. In the case of this lawsuit, the valuation was done by market value and then according to the asset's net income and cash flow. The fascinating part of the lawsuit was he factored in not only just the current value of the assets, but he also factored in how much money was lost as it wasn't invested in interest-bearing assets. As such, he factored in his assets growing at 12% per year during the 10 years that he was a minor as part of his claim against his uncles. The main point behind the lawsuit was it showed how diversified his father's investments were. He had slaves, factory equipment, and other inventories. He diversified loans, including risky bottomry loans and bank deposits. All this is to say that when presenting the case to a jury, it is presumed that the ordinary citizens who made up these juries must have had the ability to understand how these calculations worked, along with the long-term planning that went into how these businesses operated. As such, it appears that these ancient Athenians possessed a substantial amount of financial literacy. In large part, the reason why ancient Athens was so wealthy was the fact that maybe its founders got a little lucky in its location, as it happened to be in close proximity to the Laurion mines, which were one of the richest silver deposits in the ancient world. This fact alone helped Athens overcome the fact that they weren't blessed with adequate fertile farmland. So having the abundance of silver meant that they could trade and import their needs. In addition, the silver was used to pay its laborers to build the city's infrastructure. At its peak, the silver extracted from the Laurion mines was around 750 talents of silver, or roughly 20 tons. Furthermore, it was estimated by historian Gil Davis that 700 talents of silver created 4 million drachmas. 1 drachma was worth a day's labor. This was a major reason why the Acropolis was built, and why they can build a navy to defend themselves from the mighty Persian Empire. At most other ports, merchants were compelled to ship a return cargo because the local currency had no circulation in other states. At most ports, a ship arriving with goods couldn't just leave with local coins. The coins weren't accepted in other states. This forced merchants to find specific return cargo. Nonetheless, the Athenian drachmas were similar to the US dollar in its role as a predominant, widely accepted international trade currency, which some historians compared to a modern reserve currency in the ancient world. The advantage of a reserve currency is to help smooth international transactions. Xenophon was alluding to the fact that an Athenian trader who had drachmas may not have needed to exchange his drachmas for the local currency when conducting deals on foreign lands. Each foreign land had its own currency because each city-state had developed their own local currency. This means transaction costs were lowered, as bankers may not have been needed to step in as middlemen, at a fee of course, to change the money. This means that the trader can retain more profits or grab more market share, as he could lower his price in relation to a foreign merchant doing business. Additionally, the importing merchant might use a currency that isn't used much outside of its borders, and trading that currency might be difficult. By using a widely circulated currency, such as the US dollar in modern times or the Athenian drachma, the merchants transacting with each other could eliminate these risks. The issuer of a reserve currency, whether it's the US dollar or the Athenian drachma in this case, also benefits. The more the people and merchants use the reserve currency means more transactions denominated in that currency outside of its borders, which then means their currency gets even more liquid, meaning demand increases. Liquidity means that the financial assets, such as the drachmas, can be priced more easily, and people will lend more in that currency, which means interest rates will generally be pushed downward. This is a major reason why U.S. businesses generally get easier access to working capital because of the dollar's reserve status. There is, of course, a downside to having a reserve currency. The U.S. has had a substantial trade deficit going on 40 to 50 years. Being the reserve currency means more demand for that currency, assuming the Federal Reserve does not have a quantitative easing policy and therefore does not pump a substantial amount of US dollars into the global economy, and the price of dollars compared to other currencies will cause the exchange rate to increase. All other things being equal, the price of US goods are now more expensive to foreigners compared to other goods, which reduces the demand for the now higher priced US exports. As such, foreign goods become less expensive to US made goods, which then spurs domestic consumers to purchase less expensive foreign made goods, and therefore imports increase. This is why a lot of modern economies prefer their currency to be devalued in relation to foreign competitors. This has been a major complaint regarding Chinese currency manipulation, as many have accused the People's Bank of China of selling yuan and buying massive amounts of US dollars and other foreign currencies to keep the yuan artificially cheap, which boosted Chinese exports and created a huge trade surplus. Obviously, the Athenians didn't have the ability to manipulate its currency in that regards, but the Athenians effectively manipulated their drachmas for foreign trade, not by debasing it, as they kept the purity high, but by standardizing its exceptional silver purity by weight, known as the Attic Standard, making their owl tetradrachmas the dominant trusted international currency across the Mediterranean. This not only facilitated massive amounts of international trade, but it also projected Athenian power. They even enforced local use of their laws. This was all done by the Athenian Assembly and Council, as they directly managed the money supply and ensured currency integrity. The drachma's role as almost an international reserve currency was mostly due to the fact it was their ability to extract so much silver from its mines. The reason why it extracted so much may have been from the fact that its mining operations were not state-owned. Instead, the mines were worked by private enterprise through extensive amounts of slave labor. In order to get the capital to buy the equipment and the slaves, these mine operators often resorted to pooling together investors. It sounds like there were two rounds of investment. The first round was for prospecting investments, whereas investors had to win the auction put on by the states that allowed them to lease the unexplored or even previously abandoned tracts of land. If they hit pay dirt, then a second round of investment was needed to extract and separate the lead from the silver. This operation required the ore to be smashed, heated, and then reheated, which required tons of water. This was in large part because Greek metallurgical knowledge mastered separating silver from the lead contained in the local ore. These mining investments, along with their metallurgical skill, correlated with the rise of Athens. The investors knew that they could mint their Attic Standard silver coins, which defined the weight of those silver coins at 4.3 grams of silver. Luckily for us, numerous stone steles have been discovered in and around Athens, which have inscribed records of the local Laurion mine concessions, of which the locations of the steles may have been where the ancient bankers sat on their benches and conducted business. For example, in 346 BCE, an entrepreneur named Pantanatus leased a mine and then borrowed about 100 minas or 10,000 drachmas from Archias. and Antiphanes to buy into a partnership that owned the slaves and workshops to run the mining operation. In other words, these were very expensive and risky operations that could lead to ruin or riches. In this case, it didn't go smoothly, as Pantanatus defaulted on his debt. The creditors Archias and Antiphanes were therefore entitled to seize the mortgaged property, which included the workshop and the slaves. Before they seized the assets, a third party had stepped in by the names of Nicobus and Evergus. They paid Pantanatus the original debt to the bankers, effectively taking over the loan and its security. In return, Pantanatus formally sold them the workshop and the slaves with a contractual agreement in place that he could repurchase once he repaid Nicobus and Evergus, who were the third parties in this deal. Therefore, a new contract was drawn up, whereas Pantanatus would pay interest on the loan. He would then pay a mining tax to the state. Crucially, if he missed a single payment, the sale would become obsolete and irreversible. This was a harsh all-or-nothing clause, but the parties agreed to it. Not surprisingly, Pantanatus missed a payment. Nicobulus and Evergus invoked the contract and foreclosed. They took permanent possession of the workshop and the slaves. They then sold this property to an unnamed plaintiff. Pantanatus, now stripped of his livelihood, was furious. He claimed that the foreclosure was unfair and harassed the new owner, which was the plaintiff. Pantanatus took it personal and possibly stirred up a mob of slaves and miners to besiege the workshop. To resolve the pandemonium, the plaintiff, which was the new owner, sued Nicobus and Evergus for damages, arguing that they sold him the property with a contended title and ongoing legal troubles. Pantanatus testified on his behalf in the trial. Nicobulus defended himself and argued that they had acted legally and justly. They saw an opportunity to save Pantanatus from immediate seizure by his original creditors. The contract signed by both sides was clear. Pantanatus agreed to the terms, even if they were quite severe, as he knew the consequences of default. Pantanatus was portrayed as a galling and dishonest debtor who was now causing trouble out of anger and spite after he failed to meet his obligations as a debtor. They went on to explain that they were the real victims of this bad business deal and an unappreciative debtor. This case is yet another goldmine, pun intended, for understanding ancient Athenian banking and contract law. As such, you can see the same case going in front of a modern jury. It shows a multi-layered credit system with loans being transferred and refinanced. Unlike modern banking, there was no central banking authority, so credit was a web of personal and contractual relationships. The case also shows how the Athenian silver mines at Laurion were the engine of the economy, but financing them meant the person or the partnership would be taking on a ton of risk. Inherently, this also meant these investments could potentially be extremely lucrative if successful. Many of these contracts were specifically designed to protect the lenders, often with severe terms. In this case, the entrepreneur had the ability to sell his loans with an option of redemption. This was most likely a standard form of mortgage. Cases like this offer a contemporary viewer a case study that shows how it worked in practice and its potential for catastrophe for the borrower. Ultimately, this case came down to social relations versus contract law. The speech is full of appeals to fairness, gratitude, and social expectations, even while resting on strict contract law. Nicobolus portrays himself not just as a legal creditor, but as a benefactor who was betrayed. The ancient Athenians understood the use of strategic lawsuits. The third-party plaintiff's suit against Nicobolus, rather than directly against the original debtor, who was Pantanatus, shows strategic legal thinking because he probably understood that he should pursue the wealthier and possibly liquid and arguably more legally vulnerable party in the chain. The case of Pantanatus' loan default is a classic story that has been played over and over again and will continue to be played out in the courts, whereas a speculative venture took place, which resulted in a default, a foreclosure, and ensuing bitter litigation. It reveals the modern viewer, or listener in this case, that the Athenian economy was vibrant, sophisticated, and ruthlessly contracted world where written agreements were paramount, and the consequences of failure could leave people in ruin. Another thing that this case shows is how Athens operated its economy through private enterprise. The state profited handsomely through leasing of assets to private businesses through intensive bidding. That generally allowed for the state to extract the highest bids possible. Athens reduced corruption in public contracting through a system of public scrutiny, competitive bidding, robust accountability mechanisms, and severe penalties for misconduct. The system was designed to ensure transparency and prevent any single individual or group from gaining unchecked power. Additionally, the financiers allowed for nearly anything to be pledged as collateral for loans. And because of its legal system, private industry flourished as it knew it could count on the rule of law if a deal went sideways. Just as important, it appears that the average Athenian jury was financially literate enough to understand these complex cases. In the end, the need for grain to be imported into the city was most likely the ultimate catalyst for the Athenian economy. Since there wasn't any state-sponsored voyages to the Black Sea, the importation of grain was almost entirely done by private business. The sea voyage was risky and dangerous, of which many entrepreneurs may not have been up to the task to take on the seas. Therefore, they could just invest in a voyage in hope of making a handsome profit of around 20 to 30% without risking their lives in the process, while doing business with almost complete strangers or someone that they may not have had much of a history is quite astonishing. This in itself was a major step forward in international trade, as it allowed for the division of labor and risk, and with a strong legal system in place, people doing business probably felt that they could get justice if one side of the deal did something unethical or shady. Therefore, Athens designed a financial system that allowed for the facilitation of investments and the ability to spread financial risks, of which the economy of Athens depended upon, since they were dependent upon the importation of food, and without that ability to invest in long-distance trade, they could not have supported its population. These financial investments and innovations were backed by the rule of law, meaning people who were harmed would have the ability to have their cases adjudicated by a public jury. I want to thank you for taking your time to listen or watch this episode. If you like what you hear and want to donate to the show, you can visit us at patreon.com/history of money banking trade, or you can visit our website at moneybankingtrade.com. Thank you very much. Talk to you soon.